Hello, and welcome to the June IASB Update podcast. My name is Nili Shah, and I am the Executive Technical Director at the IASB. As has been the case for the last few months, I'm joined by Andreas Barckow, Chair of the IASB. Andreas, welcome.
Thank you, Nili.
And here we are today to share highlights with you from our June IASB meetings. As always, we have covered quite a few topics at this meeting. First on the list are some important discussions on our business combinations under common control project. This project is about situations where subsidiaries are under the common control of the same parent, and one subsidiary transfers a business to its sister subsidiary. The question that we're looking at is how the transfer of that business should be accounted for in the receiving subsidiary's standalone financial statements. Andreas, can you start us off with what we discussed in June on this project?
Sure. So at this meeting, the IASB discussed whether conceptually the acquisition method and/or a book value method should apply to business combinations under common control. And in particular, the IASB discussed whether some or all business combinations under common control are similar to other business combinations covered by Ifrs 3, our business combination standard, and the information needs of users receiving the entity's financial statements. The IASB wasn't asked to make any decisions at this meeting. We will discuss practical considerations in a future meeting before making decisions about the selection of the measurement method overall.
Great. Well, moving on to a second project. This is the equity method project. And as a reminder, this project is a research project, so it's earlier stage, and it's assessing if application questions on the equity method can be addressed by identifying and explaining the principles that underlie IAS 28. The IASB continued its discussions from April on the question of how an investor applies the equity method of accounting when purchasing an additional interest in an associate while retaining its significant influence. And to answer this question, the IASB is exploring two approaches: a preferred approach and what it's calling an alternative approach. So the alternative approach would view the additional interest purchased and the existing interest held as a single asset and remeasure the cost of the entire investment to fair value at the date of acquisition of the additional interest. In contrast, the preferred approach would view the additional interest and the existing interest as an accumulation of purchases. So what this means is that the additional interest would be measured at fair value of the net assets at the date of purchasing the interest. So with these two approaches as a backdrop, in June, the IASB discussed the implications of these two approaches on two questions. First, whether the accounting if the purchase of an additional interest is a bargain, and secondly, the accounting for a partial disposal of an interest. The IASB in June tentatively decided that if an investor applies the preferred approach, they would recognize a bargain purchase or gain in profit or loss, again, if that additional interest purchased is a bargain. It also decided to measure the portion of the carrying amount of an investment in an associate to be recognized in a partial disposal by using a specific identification method if the investor can identify the specific portion of the investment being disposed of and its cost, or the last in, first out method if the specific portion of the investment being disposed of cannot be identified. However, there were a few follow-on questions that the board flagged for the staff to explore further on measuring the carrying amount of the portion of the investment to be derecognized. Also in June, the board discussed some other questions but did not make decisions regarding how to account for changes in an investor's ownership in an associate that arises from changes in the equity of the associate. So for example, if the associate issues shares. And going forward, the IASB will continue to discuss its application questions within the scope of this project. Andreas, why don't we move on to financial instruments? We talked about three different projects in June: financial instruments with characteristics of equity, and we also talked about a couple of matters related to the post-implementation review of IFRS 9. Do you want to get us started with FICE?
Yep, absolutely. So as a reminder, the FICE project is focused on addressing the challenges in determining the classification of financial instruments with characteristics of equity as either liability or equity. The IASB continued its discussion on the reclassification of financial instruments when the substance of the contract changes without a modification to the contract. This could occur for reasons such as a change in interest rate or a change in functional currency. The staff presented three possible alternatives how to account for such changes. First, not at all, that is, prohibiting reclassification, which basically is the approach taken in IAS 32 today. Second, in every case, that is, any change must be assessed for potential changes in classification. And a third approach being in only some cases, but not all. The staff characterized the third approach as their preferred approach, under which an entity would have to assess those changes in the substance of a contract for reclassifications that are not due to passage of time. The staff acknowledged that this would constitute a change from today's principles, but thought it would be justified as it would lead to better information for users. The accounting of any change of classification would follow the principles that already exist in IAS 32, namely a financial liability reclassified from equity would be measured at fair value at the date of reclassification, and any difference between the carrying amount and the fair value will be recognized in equity. The other way around, an entity instrument reclassified from a financial liability will be measured at the carrying amount at the date of reclassification, and no gain or loss will be recognized. For reasons of reduced complexity, the staff proposed to let any reclassification take effect as from the start of the next reporting period. The staff also noted that this would follow a similar logic as contained in IFRS 9 when entities account for a change in business model. So where did we land? The IASB tentatively agreed with the staff's preferred approach, but decided that the reclassification should be accounted for in the reporting period in which the change in circumstance occurred, rather than from the start of the following period. The rationale for that was that we believed that this would be more in line with the principles for reclassification that already exist in IAS 32. The IASB will continue its discussions on FIs at a future meeting. So, Nili, do you want to cover the other topics?
Why don't I start off continuing with financial instruments and talk about one of the projects that arose from the post-implementation review of the classification and measurement requirements in IFRS 9. And then Andreas, maybe if you could talk a little bit more about other aspects of that post-implementation review, and then we can go on to the more advanced projects outside of the financial instrument space.
Sounds good to me.
All right, so with respect to the PIR of the classification and measurement requirements in IFRS 9, one of the areas of feedback that we heard is that the requirements in IFRS 9 for assessing a financial asset's contractual cash flow characteristics, so that is the solely payments of principal and interest, or the more commonly known SPPI requirements, there were some questions about the application with that. So last month, the IASB decided to add a narrow scope project to identify or to clarify these requirements. This month, the IASB discussed the project scope, objective, and timetable. The purpose of this narrow scope project is to provide greater clarity as to how an entity would assess instruments linked to ESG features against the SPPI test. And just for clarity, the decision is not to create an exception for which such instruments would be accounted for at amortized cost. Again, it's about clarifying principles. And the reason that the board decided against an exception is that stakeholders had told us that the SPPI test is working as intended and should not be changed. The board also discussed that this project would be looking at the concept of a basic lending instrument. And given that the IASB had already is doing a narrow scope project, it felt that it could include in this project a look at clarifying specific topics in the accounting for contractually linked instruments and the relevance of contingent events to determining whether cash flows are SPPI. Now, these areas will be looked at, provided that they do not lead to a significant delay in finalizing the proposals around instruments linked to ESG features, which remains the top priority for the board. And the next step in this project will be to publish an exposure draft, which is anticipated for the first quarter of 2023.
Very good. So shall I then continue with another area in the post-implementation review of the first phase of IFRS 9, Nili?
Yep, that sounds great.
Okay, so this month the IASB continued its discussion of feedback on the post-implementation review on the classification and measurement requirements in IFRS 9. The board was presented with and discussed feedback relating to the measurement of equity investments at fair value through profit and loss, and the exception to present fair value changes in other comprehensive income without recycling to P&L upon disposal of the equity investment. It was also presented with the first batch of academic studies that had assessed the impact of the change in the accounting for equity instruments, both under IFRS as well as under US GAAP. So starting with the academic evidence, the IASB noted that the change in the accounting models had not led to any noticeable impact on the holdings of equity instruments, contrary to what some stakeholders have feared. With regard to banning recycling, the academic studies yielded inconclusive results, suggesting that the polarized views still exist. And switching to the feedback on the PIR, views were equally mixed, with some stakeholders suggesting that the scope of instruments to be included in other comprehensive income be expanded and to reintroduce recycling to gains and losses from other comprehensive income to profit or loss. Other stakeholders said the scope and non-recycling of gains and losses works well. So I should note that this session was not a decision-making session. We will be discussing this topic further next month. So back to you, Nili.
Thank you, Andreas. Lots to look forward to in the coming months. So why don't we switch gears now and move to our non-financial instruments topics. We have a number of standard setting projects that are quite advanced in the development and finalization. I'll start with our project on primary financial statements. The board had quite a good discussion this month on management performance measures. And as you all might recall, this project seeks to improve how information is communicated in the financial statements with the focus on the statement of profit or loss. In June, the IASB decided to require that additional subtotals and line items presented in the statement of financial performance fit into the structure of the categories that have been defined in the upcoming accounting standard. The board also decided to withdraw a proposal in the exposure draft that prohibited the use of columns for presenting management performance measures in the statement of financial performance. So said differently, the final accounting standard is now expected to allow for the use of columns, which is something that is more common in some jurisdictions than others. So I think that might be helpful for some stakeholders.
So next on the list is subsidiaries without public accountability, the last remnant of our disclosure initiatives project, I suppose. The IASB met to decide the direction of the project based on the feedback received from the exposure draft. The project seeks to potentially reduce costs and simplify preparation of financial statements for subsidiaries that do not have public accountability. The IASB decided to proceed with the proposals in the exposure draft subject to redeliberations and develop a final IFRS accounting standard. We also decided to include in the standard disclosure requirements in IFRS accounting standards issued as at February 2021. So have that as a cutoff date, and not to publish a catch-up exposure draft before the final subsidiaries without public accountability standard is issued. A catch-up exposure draft covering all the changes that have happened since February 2021, will expose changes to the subsidiaries without public accountability standard for disclosure amendments made to IFRS accounting standards between February 2021 and when the subsidiaries without public accountability standard is issued. The board will publish this catch-up exposure draft after the final subsidiaries without public accountability standard is issued.
Thanks, Andreas. So let's move on to another standard setting project that's quite well advanced. This is our IFRS for SMEs project. In June, the IASB wrapped up its decision making with some final decisions on guidance on public accountability, IFRS 15, and Section 23. The IASB also proposed transition requirements to help with the application of the new standard. Now the IASB will begin the balloting process for the exposure draft, which is expected to be published in September with a comment period of 180 days.
So then finally to a rather narrow project, the non-current liabilities with covenants. This project is, as I said, narrow scope and came from the Interpretations Committee. The project objective is to clarify how a company classifies liabilities with covenants as current or non-current. At this meeting, the IASB was presented with the feedback from the 2021 exposure draft it had issued in addressing some concerns that had arisen on the preceding exposure draft. The feedback covered classification of liabilities as current or non-current, disclosure of information about covenants, and separate presentations. So let me take each of these in turn. With regard to classification of liabilities as current or non-current, almost all respondents agreed with the proposal, so that's good news. As regards disclosure of information about covenants, most respondents generally supported enhancing disclosure about covenants, but suggested small revisions. And lastly, to separate presentation, most respondents disagreed with the proposal to require separate presentation of non-current liabilities subject to compliance with covenants. So having heard that feedback, the IASB decided on each of these three issues. And again, I will take it in turn. With regard to classification, the IASB decided to confirm the proposal that only covenants with which a company must comply on or before the reporting date would affect the classification. As far as a disclosure of information about covenants is concerned, we decided to modify the proposal on disclosures with small revisions. And lastly, as far as separate presentation of non-current liabilities is concerned, given the feedback, the board decided not to finalize the proposal, as the feedback suggests that separate presentation is unnecessary. Instead, the board decided to require the disclosure of the carrying amount of the liabilities in the notes. We also discussed the effective date and transition and decided that we would require the amendments to be applied retrospectively and to defer the effective date of the 2020 amendments, so the previous requirements, to align with these proposals, but it won't be earlier than January 1st, 2024. We will discuss the effective date at a future meeting. So that's about it.
Thanks, Andreas. I think that last point will be a big relief for stakeholders who are thinking that they would have to apply the January 2020 amendments as of January 1, 2023. And the expectation on this project is to issue the final amendments by the end of the year, so that effective date will be official and final. So that rounds off our June IASB meeting. Just a couple other things to highlight. The first is that the feedback statement and project report for the post-implementation review of IFRS 10, 11, and 12 was published towards the end of June. And as always, you can catch up on previous episodes of this and the IFRS Interpretations Committee on our website, as well as your preferred YouTube channel and Spotify. And for the latest developments, please make sure to subscribe on our website. If you like this podcast, please do take some time to rate, review, and subscribe on your preferred podcast player. And remember to tune in next month. Thank you for your time.